Hello, everybody. This is Andy Lebow from Commodity Research Group, and today I am joined by Marty Stetzer, the president of EKT Interactive, and Ed Meir, the award-winning analyst, rated number one in base metals by Metals Bulletin. Ed also is a colleague, a partner at Commodity Research Group. Good morning, gentlemen. This is our weekly podcast, and we're going to talk about metals and other things from Ed. And after that, Marty and I are going to talk about the weekly stats as well as the oil markets in general. Today is Wednesday, April 24th. Ed?
Okay, thank you very much, Andy. And Marty, nice to be with you again. Hope my audio is clear. I just wanted to bring your listeners up to date on base and precious metals and review with you as to what's going on. In a nutshell, not very much actually. Base metals have kind of flatlined and are going lower over the past week or so, unlike the action we're seeing in crude. And gold and silver are also really very weak, with silver hitting a 4-month high, a 4-month low yesterday, and gold also breaking below key support at 1,280 and taking out a bunch of stops below there. We're currently at around 1275 on gold and at 1490 on silver. Not much going on in platinum or palladium either. Palladium, as you know, had a big correction a couple of weeks ago. It seems to be consolidating now around the $1,400 mark. And platinum kind of rose in sympathy, but seems to have stalled as well. So very little action in precious metals. In base metals, what's interesting is that we have been selling off despite growing optimism about the US-Chinese trade talks. I think sentiment in base metals is being influenced by the fact that China is not really ramping up stimulus programs as aggressively as people were thinking. Keep in mind that the Chinese have an enormous amount of debt they need to work with. So if they, build more bridges and airports and highways, this all entails more debt for the provinces and the regional municipalities that need to issue bonds. So what the government is doing instead is lowering rates, making credit easier, jawboning the banks to lend more money. All of this means that the bang for the buck they're getting isn't as concentrated as it would be were they to spend money, basically. So I think metals are realizing that the demand side from China is kind of slowing, just as supply is beginning to increase and is starting to replenish inventories. So we're in a bit of a down move in both base metals and precious metals, but that's not to say we're not seeing action elsewhere. And on that note, I'll turn it over to Andy, where we've had a lot of developments in crude over the last couple of weeks.
Okay, thanks, Ed. And we certainly have had a lot of developments over the last couple of weeks. Actually, over the last couple of days, we've had a lot of developments as the Trump administration has said that they are not going to issue waivers to the buyers of Iranian crude the buyers of Iranian crude as they try to realize their goal of moving Iranian exports down to zero. Now, they're not going to get to zero on the waivers, and I guess the big unknown is what the negotiations are going to be with the Chinese. The Chinese buy about 500,000 to 600,000 barrels a day from the Iranians. And of course, that's a complex dance with the trade negotiations with the U.S. So we'll see what China does. There's probably about 300,000 barrels a day of leakage coming out of Iran. That will almost certainly increase some. Through our numbers show that the failure to grant sanctions will probably lead to another production loss of about 750 to 800,000 barrels a day. Goldman yesterday said 900,000 barrels a day, and that's certainly possible. Clearly, besides what the Chinese do, what the Saudis do is the next step. The Saudis can make up that volume along with the UAE. The Saudis have said that right now they don't plan to immediately increase production, but if their customers ask for more barrels, they will provide them. UAE too will probably be able to increase production. We may be able to get a little bit more out of Iraq. So it is definitely a dance. But what the key thing is that right now OPEC is producing about 30.2 million barrels a day, maybe 30.3. The call for OPEC crude, the demand for OPEC crude in second and third quarter, as predicted by OPEC itself, is about 30.8 million barrels a day. So there is a shortfall. Al-Falih, the Saudi minister, said that he didn't think that there was. He thought the markets were balanced and that inventories were ample. They're not really. Inventories are, in terms of day supply, are running like a day behind the 5-year average. In terms of total supply, they're only 7 million barrels above the 5-year average, according to OPEC itself. So it looks as though in second and third quarter, unless the Saudis really ramp up production significantly, we're still going to have, it looks like there's going to be a deficit despite what Al-Falih and the Trump administration is saying. So that's, obviously why the market has been in this sharp uptrend. Today we're losing some ground owing to the EIAs, which I'll talk about in a minute. And it's also one of the reasons why the speculators have poured into this market. The net length on WTI is up by 60,000 barrels in the last 60,000 contracts. That's 60 million barrels in just the last 2 weeks. We've seen a big speculative increase in the market. But you look at the fundamentals, at least for the second and third quarter, they look constructive. They definitely look constructive. How much is already in the market? Unclear, but I think the market looks as if it may have some more upside.
Andy, Marty, quick point for our listeners who are kind of new to the industry, to put the numbers in perspective for Iran. A year ago or more, when the sanctions were first put in place, they were producing almost 3 million barrels a day. And now they're producing in the range of 1.4 to 1.5 million barrels a day. And the target, as you've heard from Andy and others, is maybe they'll get down to 500,000 barrels a day. So think of the impact on their budget in 2 years to go from about 3 million barrels a day to 500,000 or so. The country's really got to be hurting, since this is one of their biggest sources of foreign exchange.
Yeah, there's no doubt that it's having an impact on the Iranian economy, and those numbers were exports. Production was their demand is like internal demand's like 1 million barrels a day. So, their production was like 3.8, 3.9 before the sanctions, and now it's down to 2.7 on its way lower, unless they move some of the supplies into floating storage. Speaking about floating storage, Marty, You had an interesting point on what's going on on the shipping side.
Exactly. In a lot of our training, we talk about the impact of midstream on upstream operations, and we usually talk about pipelines in the Permian. But the Wall Street Journal reported that Clarksons, who is one of the biggest shipbrokers in the world based in the UK, does an excellent job of forecasting and providing data, say that ship orders have shrunk to their lowest level in 15 years, and especially in crude and product carriers that used to make up about 2/3 of all the orders, and now it's down to less than half. So in addition to sanctions and demand slowing down, there's been a huge shift in the amount of crude that needs to be moved. And I think that'll be reflected even more as time goes by.
And that sounds like we got to serve up a podcast on what's going on in shipping and maybe what's going on in the on IMO 2020, which is going to be the very key for third and fourth quarter and into first quarter next year. Commodity Research Group, coincidentally, has an expert on shipping, Gary Bush, and I think we'll maybe feature Gary in an upcoming podcast on shipping and what's going on in the tanker markets.
I think our listeners would really appreciate that, Andy. Great idea.
Yeah. I think that would work. I just quickly, I'm going to do. Let's see if I could do the EIAs in 90 seconds. The EIA numbers were somewhat bearish, at least for crude, showing a build of 5.4 million, although a lot of that was the so-called adjustment or the fudge factor was made up 4.5 million of it. But, there was enough to get the market to take some profits. Gasoline continues to be bullish. Drew by 2.2 million. Demand is strong, and inventories are very low going into the teeth of the driving season. So we'll see what goes. Gasoline looks bullish. Diesel distillates, a draw of 0.7. That's around what the market was looking for. Its days supplies are catching up to normal at 33.6 versus 35.1. And total inventories built by 9 million, mostly crude. Days supply there are 61.7. The 4-year average is 64. So days supply is, I would say, total inventories are adequate to a little bit below adequate. Again, contrasting to what the Trump administration has been talking about. Cushing stocks rose by 500,000 barrels, and the market, which has been basically going straight up, just took that rise in crude, and I think it was a sign or a signal to just take profits this morning. I do think that. Crude stocks are, the crude prices still have some upside, but obviously there's a lot on the plate here coming up. There's an OPEC and non-OPEC ministerial meeting on May 19th, followed by an OPEC meeting on June 25th, and we've got the geopolitical minuet with the Russians, the Americans, the Saudis, and the Chinese. So it's going to be an interesting couple of weeks coming up here, a couple of months coming up here in the oil market. That's it for me. Marty or Ed, anything to add?
I have a question for Ed, and this is, again, it's been really helpful for me to learn more about the metals markets as we've been expanding our horizons on our podcast. Is there any relationship in the financial community, the investors who invest in commodities, between crude oil, which is often treated as an investment commodity, and precious metals? Is there any kind of relationship that you've observed over time, or are they kind of independent markets with their own behaviors?
That's a good question. Actually, we ran a bunch of correlations for gold against various commodities and currencies, crude being one of them. And the correlation with crude was very high, strikingly high. It was something like 75%, if I remember correctly. But of course, that has broken down over the last few months, as your listeners know. But going back 30 years or so, there is a pretty high correlation between the two.
Interesting. So they look on it as a portfolio investment, not just crude oil being moved into a gasoline market.
Correct. Yeah. They do, especially these index funds. The indices are very heavily weighted in crude oil plus all the corresponding products, as well as gold. So when the indexes get active, you see both of those commodities move higher in tandem.
Thanks, Ed. That was a big help.
Okay, let's wrap it up. If you're interested in correlations, if you're interested in more, if you want to hear more on the correlations, more on metals, more on oil, where we think the price is going, we do a monthly podcast which features options with Jim Colburn, as well as these weekly comments. Please feel free to go to our website at commodityresearchgroup.com. And if you want to get a hold of us, try me at Lebow at commodityresearchgroup.com. That's Lebow at commodityresearchgroup.com. Marty?
Thanks for the opportunity to participate, Andy and Ed. I really enjoyed it, and as usual, I learn something every time I do this. If any of your listeners on the trading side are interested in learning more about the physical aspects of the business, why do we talk about pipelines? Why do we talk about tankers? Why do we talk about refineries? And the impact on both price, supply, demand, movements, etc. They might enjoy taking a look at our free Global Ready Oil 101 series that discusses upstream, midstream, and downstream at www.ektinteractive.com. I'd like to thank everyone for listening.